You're sitting there at 11 p.m. on a Tuesday, staring at your phone screen. You've got 5 tabs open. One guy on YouTube is telling you that if you don't buy Tesla or Nvidia right now, you're going to be working until you're 85. Another guy is screaming that individual stocks are a scam and you just need to buy the S&P 500 and go to sleep. You've got $5,000 sitting in your checking account losing value to inflation every single day, and you're paralyzed. You do nothing because you're terrified of making the wrong choice. Sound familiar? Yeah, I've been there. My name is Nick, and I spend way too much time thinking about how to build actual generational wealth without losing your mind in the process. If you're someone who is tired of the fake guru noise and just wants the actual math behind how money works, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we are settling the biggest debate in investing: ETFs versus individual stocks. And we're not using theories. We're using the real math of the last 20 years. Here's the thing. We've all been sold this lie that the only way to get really rich is to pick the next Apple or the next Amazon. Wall Street loves this narrative because it makes you trade more, which means they collect more fees. Look, picking a winning stock feels incredible. It hits the exact same dopamine receptors in your brain as pulling the lever on a slot machine. But let me hit you with a statistic that should completely change how you look at your portfolio. According to a massive study by J.P. Morgan Asset Management that looked at the stock market from 1980 to 2020, get this, 44% of all individual stocks suffered a catastrophic loss, meaning they dropped by 70% or more and never recovered, almost half. Now you might be thinking, but Nick, I'm smart. I only invest in good blue-chip companies. Okay, let's do the real math. Let's rewind exactly 20 years. It's 2006. You have $10,000 to invest. You decide you're going to split it into 2 different strategies. Strategy A, you put $5,000 into a broad market ETF. Let's say the Vanguard S and P500 ETF, VOO. Strategy B, you put $5,000 into General Electric, GE. Why GE? Because in 2006, GE wasn't just a good company. It was the most valuable, untouchable blue-chip company on the planet. It was the Apple of its day. Let's fast forward 20 years to today. That $5,000 in the S&P 500 ETF. With dividends reinvested, it grew at an average of about 10% a year. Today, that $5,000 is worth roughly $33,600. You did absolutely no work. You just let American business do its thing. Now, what about General Electric, the safest individual stock in the world? After 2 decades of corporate mismanagement, the financial crisis, and restructuring, your $5,000 investment in GE is now worth about $3,200. You didn't just miss out on growth, you lost money over 20 years. Here's what most people don't realize. The risk of individual stocks isn't just financial, it's psychological. When you own individual stocks, your money controls your emotions. Every earnings report, every CEO tweet, every slight market dip becomes a source of anxiety. You start panic selling when things go down, and FOMO buying when things go up. It's exhausting. Think of it like this. Buying an individual stock is like trying to guess which specific horse is going to win the Kentucky Derby. It's thrilling, but highly risky. Buying an ETF is like buying the entire racetrack. It doesn't matter which horse wins, because you own the track. You get paid regardless of who crosses the finish line first. But this is where it gets really interesting, because I know some of you watching this still want to pick stocks. You have that itch. And honestly, that's fine. But you have to use what I call the 90-10 rule of sanity. Take 90% of your investing money and put it into boring, broad market ETFs. Set it on auto pay. Do not look at it. Let compound interest do the heavy lifting. Take the remaining 10% and use it as your play money. Buy your individual stocks. Try to find the next Nvidia. If you lose it, your retirement is still safe in the 90%. If it skyrockets to the moon, great, you get to feel like a genius. The wrap up. Look, investing shouldn't be a second full-time job. It shouldn't keep you up at night. The math proves that for 99% of people, buying the whole haystack, the ETF, is infinitely more profitable and less stressful than trying to find the needle, the individual stock. Stop letting Wall Street convince you that investing needs to be complicated. Start automating your ETF purchases this week, even if it's just $50. If this video helped you see your portfolio differently, please hit that like button. It really helps the channel. And drop a comment below. Are you team ETF or team individual stocks? I read every single one. My name is Nick. Keep building, and I'll see you in the next one.